All right. Hey, everybody. Thanks for tuning in to another episode of BlockFi Live. We're still completely remote. It's the end of September 2020. One of us on the panel is in an office. It's Tushar, but everyone else is working from home. So we don't have the cool BlockFi studio backgrounds or everybody in person. But we've got a fantastic group of guests here today. We're going to be talking about hedge funds and asset management in the crypto sector. Thank you to all of our panelists for joining and chatting with us today, and thanks everybody who's watching for tuning in. So to start, I'm just going to say who we have on here and give everyone an opportunity to introduce themselves and their firm and talk a little bit about how crypto is relevant to them or what they're doing in the crypto sector today. I'm going to go from my left down to the right. So Tushar Jain is the co-founder and managing partner at Multicoin Capital. Tushar, you want to say hi and tell us a little bit about yourself and Multicoin?
Sure. Thanks for having me here, Zach. Great to be on with everybody. So Multicoin is an asset manager focused exclusively on the crypto space. We manage a hedge fund and a venture fund side by side. And really, we're focused on taking longer-term fundamental views on crypto assets out there. We've, backed a number of early-stage teams, and we also, trade in the public markets. But really, with a fundamentals-focused view, we're not necessarily, high-frequency traders or anything like that. And we usually look for holding periods, in the months to years type time frame.
Awesome, thanks. Ken Monahan is a senior analyst for market structure and technology at Greenwich Associates. Ken, you want to say hi and tell us a little bit about what you're doing in the crypto neck of the woods at Greenwich Associates?
Sure. Hi, Ken Monahan. So we're a research firm, so we're not actually engaged in the markets per se. We observe them. Greenwich has a lot of infrastructure for sort of taking the temperature of the markets. We have an investment management practice where we speak to allocators and to ask sort of traditional asset management firms, and we measure their level of interest, how much infrastructure they're building, this sort of thing in the crypto world. And then we also we have a lot of technical expertise with regard to market structure itself. So we actually look at the exchanges themselves, the custody infrastructure, things like the CME product launches, et cetera, that kind of thing. So we're sort of observers of the larger ecosystem rather than a participant itself.
Awesome. Who are your primary kind of clients? Because y'all do a lot of advisory work for folks, right? So when you're talking about this research, what's your main audience?
So we basically, like, we have kind of a number of product lines. Like, one, we have a research subscription where like big asset managers, platforms, some sell side firms will subscribe, and as we learn things, we publish this research to them so they can keep up on current events. And then we also have a sort of bespoke advisory version where like actually firms will come to us and say, hey, listen, what is the size of the crypto custody market, right? Like, this OCC letter has come out, right? Do the economics of the custody business militate in favor of us expanding into this realm? So we have the bespoke advisory work, and then we have sort of a general, like, this is what's going on in the world type subscription service.
Got it. Thanks for that. Adam Guren is the Chief Investment Officer and founder at Hunting Hill. Adam, you want to say hi and introduce yourself?
Sure. Zach, thanks for having me on, and BlockFi for putting this together. Zach mentioned I'm the founder and CIO of Hunting Hill, which is an investment manager based in New York City. We manage over $300 million in fund assets and an additional $200 million in managed accounts. So with leverage applied to the assets, we manage about $2 billion in balance sheet. And of that $2 billion, there's about 20% of it dedicated to crypto-related trades. So ballpark, we're about $400 million in our crypto strategies. And our first foray into the markets, we're back in 2016. We run an ETF and index strategy out of our flagship vehicle, and one of the screens that we were running picked up on a Bitcoin closed-end fund, and we started to look into the space back then. And as it grew in 2017, with obviously the asset appreciation, we just started to trade more into the space and got more active. And fast forwarding to 2020, continued to grow. And we're excited about the opportunity set that we're seeing going forward, and just the ecosystem that's been built out. And it's an interesting space for somebody that's coming from the traditional backgrounds that we have on our team, and certainly excited about the opportunity set here.
Awesome. And then last but not least, Michael Hall is the founding partner and chief investment officer at Nickel Digital Asset Management. Michael, you want to say hi and give us a bit of an intro on Nickel?
Yeah, hi. Firstly, thank you, Zach. Thank you, BlockFi, for having me on and all of us on. Great to meet everybody else. Nickel Digital Asset Management is a London-based asset manager. We're regulated by the FCA. We should shortly be authorized by the FCA. And we are setting up a series of Cayman funds. We've launched one already a year and a half ago, an Arbitrage Fund that's been up about 10% with no down months and a Sharpe ratio of 5 over that period. So very pure arbitrage. We've recently launched a digital Bitcoin tracker called Digital Gold. And that's getting popularity from institutional European investors. And we're about to launch a multi-strategy fund all in the crypto space. Our goal as an organization is to bring institutions into digital assets. We started that with trying to find a custody solution that institutions would find acceptable. And being based in London, which is really the financial center of Europe, we're really focused on getting institutional European money into the crypto space. That's not easy. I think we'll come on to the evolution of the crypto space and what institutions are doing in it, but that's what our goal is. So all of the main partners' backgrounds in the firm, I'm one of 3 that come from people like Goldman, Fund of Funds, LSC. My background, I was at Bankers Trust and Vega and set up hedge funds myself. And we're trying to bring like an institutional focus to the crypto world.
Awesome. Thank you everyone for the intros. So Ken, I want to start with you, given that y'all have a really diverse view of asset classes and asset managers, and the way you're structured is pretty holistic in terms of financial markets. What are some of the things that you think make asset management in the crypto space unique? And what, if any, trends since y'all have started covering this have you started to see from firms like thematically like the ones that we have on our call that are starting to happen in the market, or have been in place for a while and are continuing to strengthen?
It's interesting. It's sort of like, what aspects of the crypto space are not unique, right? It's a lot of it is very, right down to the custody, right? Like, where is it that these things are held, right? Like the market infrastructure and these kinds of things are very strict. I think for this call, it might make sense to sort of take a step back and sort of think about, who are the end investors in this, and like, where do the institutions come from? Right. And also, like, what are larger sort of, asset allocators, right? Like, what are they thinking about this? Right. And we've been surveying people about this for, I guess, 4 years now. Right. It's so we focus on different topics, so it's not necessarily like, year over year, the same set of questions. And I think what we've been seeing is real money allocators, they're sort of a bit more hesitant about this. There's been a lot of retail interest, and I think most of the sophisticated institutions are a lot like the people on this call, where a lot of what they look at are relative value trades, infrastructure, sort of providing liquidity into the end user asset, the end users of the space. And a lot of those end users are not institutions, right? And the real question is, when will you get right? Really large scale institutions sort of investing in this as a real asset class, and also what kinds of tokens, what kinds of crypto assets have to be created in order for that to happen. And I think there's sort of a chicken and an egg problem at the institutional level, one level up, right? You've got all these people building out the infrastructure to provide the liquidity and to do the trading, to conduct the arbitrages, to sort of link the various things. But the issue you have is you have to find real utility behind these, behind these assets, right, that will actually generate a large, a large investor base, right, and then sort of real money interest in it, and on both the issuer side and the and the asset manager side. So you see really sophisticated firms, like the people on this call, right, conducting these various arbitrages. It's remarkable. You could, people set up borrow loan, markets in Bitcoin, in 2015. Right, so you could borrow an asset that couldn't be traded on any formal exchange, many years ago. But I think a lot of larger institutions, both on the issuer side, and by this I mean like the really big banks, right, that might use settlement coins, different things like this, tokenization of assets, on their own balance sheets, right. There are a lot of people working on these projects, but they've yet to really materialize. But you do have a ton of sophistication. It's just sort of serving a more retail market for the time being, while the larger allocators sort of sit on the sidelines. At least that's what we're seeing. I'd be curious to see what the other panelists think.
Yeah. So Adam, I want to go to you next. As someone who, has been in the asset management business, running very sophisticated strategies that, deliver unique returns in traditional markets, and then taking some of that and applying it to crypto. What was that transition like for y'all in terms of seeing and being able to capture the opportunity? And was it hard to get set up for that? And then maybe give us a little bit of insight into, how your investor base reacted to it, and what, if any, trends you're seeing as you've gone down this path of setting up strategies, I think specifically targeted, unique strategies specifically targeted to the crypto space, in terms of reception, talking to potential allocators. There's like 3 questions there.
Yeah. So,
yeah.
yeah.
A little bit of the
evolution. I'll try to break them down. I'll try to break them down a little bit. Yeah, I think on just the first question around strategy and access to the markets and executing, I think that we learned a lot by doing. Like I said, we started back in 2016 and did some research and kind of got a better understanding of the space. And honestly, when I first looked at it, or even before I looked at it, I thought that the crypto markets were going to be easier to navigate from just a scaling perspective, like being able to move large amounts of capital around was going to be easier than the traditional space. And then honestly, it hasn't necessarily turned out to be the case. And maybe that's part of what Ken was sort of describing, is that you need to have some of the more traditional players with large scale and balance sheet to help with that. But to be honest, for us, that's it's been good from a trading perspective, because that opportunity then falls to us, where we're able to capitalize on some of the inefficiencies or market structure issues that occur in the space. And so that's slowly changing over time, right? The ecosystem is growing and building out, and obviously players like BlockFi, where you have lending markets and borrow markets that are out there, and also with execution. So there are bigger players coming in and helping facilitate some of the institutional investor base that's the demand is growing. So you have brand names like Fidelity that are obviously out there, and I think that more players like Fidelity that enter the space will allow more adoption for institutional investors, at least from what we're seeing. The demand has been there on an institutional investor side to learn more, right? So they want to understand what's going on in the space. How can I engage? How can I invest? And that's always been good. And frankly, over the last 3 to 4 months, we've had actually institutional investors really knock down the door a lot harder than they have in the past. So I think that whatever's happened more recently in monetary policy, fiscal policy has sort of pushed the institutional investor to look more into the space, as crypto and Bitcoin generally have kind of been chosen as a potential store of value in this environment, which I think is interesting. And then maybe just to hopefully answer the third question of like how do the institutional investors eventually get comfortable, and I think that they do, at least for us, they do a process that they would for the traditional side the same. So operational due diligence is the same, and portfolio due diligence is the same, if not more stringent, to get a better understanding of what we're doing and what other investor managers are doing. And when they do get comfortable, honestly, they come in with big size. I mean, our biggest investor is $150 million allocation into the crypto space. And I think that, that's what we'll continue to see once investors get comfortable that you get some real scale applied. And, there's been public announcements like a Paul Tudor Jones, which is a sort of more brand name in the hedge fund space that has come in with some real scale and with conviction. And we'll continue to see more of that as the ecosystem grows and builds out and people get more comfortable with the institutional platforms and custody that are out there.
Can I ask you, are those, I mean, you may not be able to answer this, but are those allocations that you're seeing of that scale, is that to sort of the arbitrage type relationships, or those to like outright investments?
So it's a little bit of both. So, I mean, just in the example, the investors that we typically cater to are the ones that are looking for market neutral allocations. So for us, we're sitting in that side of the space, and we're looking to try to generate some returns that have very low correlations, that have de minimis or low drawdowns, and some real outperformance when things are choppy or volatile. So that's the space that we typically cater towards. But there's also an investor group that, I mean, like a Paul Tudor Jones, he's directional, for at least publicly, yeah. He's a directional player, and he's not small. So I think there's both of those types that are coming in. We're certainly seeing more that want the directional aspect, and we have a strategy that does benchmark to the spot price of Bitcoin, so we're able to try to produce that return for those investors with some with some excess on top of spot. So that we think is going to be a growing demand, like from the institutional players, more than what we've seen in the past.
Ken, your eyes are lighting up on that last.
I'm just trying to imagine running a fund that's benchmarked to Bitcoin.
So I want to drill in a little more to that in just a minute, but I want to get Tushar's perspective as someone who's, I think, a little bit more primarily market directional and kind of making a valuation oriented bet on certain assets in the space, and what y'all have seen, how your firm has grown, and how your conversations with existing and potential future investors into your funds has kind of evolved over the last couple of years.
Yeah, I mean, you're right. We are directional. We're not doing arbitrage, or we're not one of the more kind of trading oriented firms. We are taking longer term fundamental based views on these various assets. And speaking of an investor base, I think we have a pretty diverse one. About 2/3 of our capital comes from high net worth individuals or family offices, and about 1/3 comes from institutional investors. And I define institutional investors as fiduciaries who are managing capital for someone else. And I used to wonder about this, and I've thought about it a lot. Like, why is there not more institutional capital taking directional risk in crypto? And I think it's because of a few reasons. The first is, like, it's actually not that useful to an institution. Like, the point of Bitcoin is to be a censorship-resistant store of wealth. If you're an institution, you don't really care about censorship resistance, especially not in Europe or the United States. Like, that's not important to you. But as an individual, it could be, right? And so I think if you're just worried about inflation risk, like, go buy Apple stock or Amazon or S&P 500, right? Like that'll help you with inflation risk too. You don't need Bitcoin for that. And so I think that's the big hurdle that a lot of institutions are facing, is like, what do I get by investing in crypto? Like, what is there for me, right? Versus like, oh yeah, lots of retail likes to trade this stuff, and so I can make money in trading strategies. And so at least that's what it's been historically. Now, what I think is happening, especially in 2020, I think we've seen a big move towards things happening in DeFi. And I think we've seen a lot of more interesting things happening in Web3, which is now more like, oh, I'm investing in a product. I'm investing in something that captures value, that does something. It's not just like Bitcoin is, digital gold. It just sits there. It doesn't like do anything, right? You can't make money with it unless you're trading it, or you just hope it goes up because inflation's gone up, right? And so now that we have assets out there that have cash flows, that can distribute cash flows, that actually are useful, that do stuff, what we're starting to see is people who would invest in venture are starting to take crypto a lot more seriously, because crypto venture now isn't just about, oh, I buy things that I think are going to go up because they're currencies and people are going to believe in the meme. Crypto venture now is much more about, oh, this thing fundamentally enables something that wasn't possible before, and it makes money. And I can invest in this based on, some expectation of future cash flows, rather than just, meme coins.
Yeah, I think there was we did an event with Benzinga about a week ago. You're obviously on like the forefront of some of the newest stuff happening in crypto. There was an interesting perspective that Raul Pal shared about Bitcoin and how we as an industry talk about it with investors. And he was making the case on this panel that we should move away from some of the philosophical stuff and move towards just the benefits to things like a Sharpe ratio from diversification into an asset that's relatively uncorrelated, and the performance of Bitcoin over the last 10 years in terms of its price returns, which I think is slowly starting to happen. But a lot of people get scared when they come in and they hear a very philosophical argument towards something when they don't have the use case that some of the privacy focused retail crypto investors have, which is a point you were making at the beginning, Tushar, which I totally agree with. Michael, maybe talk a little bit about, how Europe is different, if at all, or what types of things are relevant to folks there, or how the market structure and the products that y'all are building at Nickel is helping to move the ball forward for the industry with a Europe first kind of point of view.
Sure. The big difference between Europe and the US is the US is one big market of 300 million people with all the institutions around that, with one set of regulations, pretty much. Although you have like the SEC and the OCC and state regulators, it's quite a homogeneous market. The opposite's true in Europe. It's very heterogeneous. You've got the Swiss, the Germans, the French, the British. They're all moving at different speeds. Some are allowing some parts. They're allowing in the UK, for example, allowing hedge funds to start or hedge fund managers to start, but there's very little crypto banking. In Switzerland, you've got a lot of crypto banking, but not much crypto and crypto custody. And you have some fund activity, but there's probably more fund activity in London than there. So it's very fragmented. The good news is that crypto will flow to where the regulations are most friendly, and so and one can work with different European partners to get the end result one needs to deliver it for the institutions. One thing on the institutional side in Europe is that interest rates now are negative in Europe. In the US, clearly they're Fed funds 0 to 25 bips target, but in Europe they're actually negative, and that's created a big demand amongst large institutions, especially people like insurance companies, to find assets for two reasons. One is to avoid this negative carry inflation and get some inflation hedge, and the other is for a diversifier in their portfolio. So, for example, we've been in some conversations with very large insurance companies, continental insurance companies, want to put 2% of their assets into crypto, mostly Bitcoin. But why? It's a very smart move for this one person. He's going to be the first person to do this. And if he puts a percentage of his allocation into Bitcoin and it does well, then all the other institutions will follow that will boost his position and what his exposure, because he's talking about buying, around, starting off with 50 to 100 million, but his target allocation is a couple of billion, and that's just one. And so if you add that, multiply that by 10, 20 across these other similar institutions in Europe, you start to get a big ticket. And so there is movement in Europe, but there are issues like custody's been mentioned as an issue. We had a custody issue. We solved that with Copper's Wall Garden. And there are some execution issues as well about what's the size of the market, can it take the capacity they're pulling into. But essentially the big difference in Europe and the US is that it's the heterogeneity of the regulations that one has.
Yeah, it makes sense. So I want to go back to the thing that caused Ken's eyes to light up for a minute earlier in terms of Adam's comment, and then I also want to ask Ken. I think there was an interesting point highlighted by Michael there around like some of the career risks that might be associated with raising your hand and being the first person in kind of a category of investors, or maybe within your own firm, at doing something in this asset class. And I want to get Ken's perspective on whether you see some of that. But hopefully I say this correctly. So Adam, it sounded like you mentioned that y'all are working on, or you have a strategy where you are tracking to the price of Bitcoin, but with some potential improvement. Can you just go a little bit deeper into that with whatever you can share? And then Ken, if you have a question about how it works or anything, feel free to ask it, and then I'll ask you the question about career risk stuff after.
Sure.
Yeah, so we have a strategy, like you said, that is benchmarked to the spot price of Bitcoin. And as I previously mentioned, we run a separate strategy that is in the neutral space. So we are looking to capitalize on market structure and efficiencies and different dislocations in the market. And so we're essentially combining that strategy with a long holding of Bitcoin. So if we take that strategy and the target return, let's say, is in high single digit, low double digit returns, we can try to outperform the price of Bitcoin by holding the coin and running the strategy on top of it, almost like an overlay. So we're able to use the trading strategies that we've been running for years and applying them to the spot price of coin, and the sort of the benefit that we think is obviously not just the return potential, but also, as we talked about, the custody solution, which is for us sitting at Fidelity. We also have Coinbase as a second. So, using a brand name like a Fidelity to manage the custody of the coin, and then applying the trading strategies that we run to try to generate that return. So it's a unique, I think, a unique product out there, and something that we're excited about and looking to ramp up as we go out to the market with it.
So is it like you're allocated 90% or like 110% to, or how would you work that? So you basically have like a beta exposure to the underlying, and then you have your sort of alpha arbitrage attached to it to sort of generate the outperformance, right? So do you fund it somehow? Do you pledge the Bitcoin? You basically take the client's money, pledge it, then lend out some fraction of it, take the cash, deploy the cash in your arbitrage strategy, and pay that return to the client as on top of the beta.
Yeah, I think that the short answer is yes, but I think that to break it down a little bit more, we have embedded in that market neutral strategy 3 different types of trades that we run. So we run a trade that sits in the ARB space in exchange traded products. So as I mentioned, we come from the ETF world, so we're making markets in exchange traded funds. We're applying that strategy to the crypto market. So there's different products out there. There's ETNs, there's closed-end funds, there's investment trusts. So we're looking for mispricings in that space. So that's one category of trades. The second one is around futures. So, as you guys are well aware, there's a lot of different types of futures that we can access as a public investor. So obviously the largest for us is the CME Bitcoin future, but there's others that are out there on different exchanges and different coins. But given this particular strategy focuses on Bitcoin, we tend to focus on that coin for this part of the category of trades. And then the last one sits in more of a catch-all bucket that includes some vol trading. So we have a portfolio manager that focuses on vol, that we can trade options, again, on the CME or other exchanges. And then there's some special situations that occur within the Bitcoin space that we're capitalizing on. So those are the 3 types of trades or types of categories of trades that we run on top of that beta exposure that you described.
Yeah, that's an innovative idea. That you offer both a market structure sort of facilitation return and the return of the underlying.
That's right.
So Ken, what types of things, when y'all are producing research on crypto, or talking with folks about what's going on in the space and how they might get involved, what are kind of the general negative sentiment points that you hear back, or the reasons why someone doesn't want to do it? Is it Right? Is it still super early, like just lack of education? I don't even
Well, I
understand
mean, it depends who you're talking about. As you guys have all said, right? There is a population of people that, you know, this is their thing, right? Like there is, and that population is growing, right? Like the universe of people who understand this, and I think, you know, Tushar made, you know, some important points, and that, like, you know, the part of the problem is that, like, so much of the spotlight was taken by Bitcoin for a long period of time, right? And so a lot of people think like, oh, I'm going to do what? I'm going to add an asset class with, like, you know, no clear use case per se, but with an annualized standard deviation of what into this what. But that's not all there is, right? And as he points out, like, there are a lot of people innovating here and generating, you know, all kinds of interesting assets and use cases for this. You need a certain level of sophistication, both to, one, understand what that is, and the point that he makes about, like, you know, it's a venture style investment, right? The amount of due diligence you need to do on a venture style investment is, you know, manifestly different than what you need when you look at, you know, say a chart of Bitcoin in, you know, May or June of 2017 or 2016, right? Like, that's a whole different ball of wax. I think from the institutional perspective, I mean, as you point out, there's career risk, right? Like, Michael points out that, hey, look, you know, if you're the first guy to allocate 2% of your insurance fund to an asset that, you know, goes up, you know, 60%, you're a hero, right? But if you're the first guy to allocate, you know, 2% that goes down 50%, well, you know, hey, that's it for you, right? And so it's, you know, you gotta be right. And so I think, you know, something that's also in here that you know, Michael also brought up is that, you know, the regulatory and infrastructure issues, like, these are profound, right? You know, especially if you're a fiduciary, and if you're a fiduciary of a big institution, right? Like, you know, resolving that custody issue and making sure you're compliant with, you know, with the, you know, the regs such as they are, this is non-trivial. And I think the US is sort of starting to move in this, you know, in an interesting direction. I think the OCC letter, which is, you know, another one of our topics, this is really interesting, right? You know, just because you have the legal ability to do something doesn't mean you have the technical ability to do it, right? And so getting people comfortable with that. And but I think the fact that the OCC opined on it, and they've made a clear decision to sort of create the at least the legal infrastructure, and this has historically been like the #1 hurdle for really large scale institutions. They're like, look, we don't even know what the rules are for this thing, right? So we're going to stand back. And as those rules coalesce and are clear, I think, you know, that will really unlock, you know, a lot of, I mean, basically everything that, you know, all three of you are talking about, right? That'll unlock the innovation, it'll unlock institutional interest. And I mean, interestingly, it might compress some of the arbitrage profits that are made linking the different aspects of the market structure together by making it more efficient, right? But, you know, the other aspects will probably offset that.
Yeah, so I want to open this up to the group just for anyone that has thoughts. So, you know, two things recently came out in the news. The OCC guidance was one of them. There was also MicroStrategy coming out and saying publicly that they're going to, that they already have now invested part of their cash treasury holdings into Bitcoin. Does anyone have thoughts on, you know, how important or unimportant these things are in terms of the storyline and perceptions around the space that they want to share?
Yeah.
Go ahead, Tushar.
I can answer that one. I think the OCC piece was really interesting because I think it's clearly a response to the Chinese DCEP project, where China has made a pretty bold statement saying they're going to be the first country to issue their sovereign fiat currency on a blockchain. They made this announcement last year. I believe it was October 25th. Sometime in October last year, President Xi made this announcement. And since then, DCEP has been advancing significantly. And, you know, I've seen demos of it, like the thing, you know, is moving forward. And as we see currency wars start to come in, right, like having adoption of Chinese fiat currency internationally is probably the best way for China to, like, have more power against the United States in this geopolitical struggle. And so I think this OCC announcement was a response to that, such that these federally chartered banks can hold fiat currency for stablecoin issuers. Because the best response to DCEP is something like Tether or USDC or potentially even Libra. And I think that that's really the big meta game being played here. And that's what drove a lot of the regulatory decision.
Yeah, and if I could just come in on that, I think the OCC decision is great because it's going to enable institutions to be much more comfortable banking crypto. In London, we've had Goldman, JP Morgan, Barclays in our offices asking us about what does crypto look like, how does 24/7 trading work, how does prime brokerage work, how does custody work. They don't do any of this stuff now, but they want to understand it. And they're clearly keen to move into it. And if this OCC, it's giving them the green light, at least on the American side of their business. And hopefully that will bring more competition for Silvergate and Signature, because right now, if you want to bank, there are two main people in the US. It would be great to be able to go to Wells Fargo or JP Morgan, Citibank to get crypto banking as well.
Yeah, Adam, any thoughts on your end in terms of that recent news, but also just, having been running these different types of strategies for a few years now in the crypto space, do you think that news like this is helpful to opportunities for firms like yours in the sector, or do you think that it kind of signals that the opportunities might be, kind of closing or narrowing over time in terms of the types of returns that you can generate with them?
Yeah, I mean, I think that sort of answering the first part, which is, is it positive? I think I agree with the group. I mean, it's definitely positive for the industry generally. It's inevitable that you get established banking players that are going to eventually facilitate crypto trading, crypto banking, and custody. And I think that's just positive for the ecosystem. As far as it's applied to, some of the trades that we look at, I think that, to be honest, a few years ago, we looked at these trades and they were very small on a relative scale from the rest of our book. And already, because there's more institutional players now than there were 3-4 years ago, the trades have gotten bigger, and obviously we're able to scale with them. Spreads will get tighter and they'll be smaller, but I'm not necessarily sure that the wallet goes down. All right, so if it is sort of Michael, I think we mentioned if there's somebody that allocates $2 billion to Bitcoin by itself, and they're one player of many, there's going to be a lot of movement in the space between now and when things become extremely efficient, like the S&P 500. And frankly, coming from the traditional space, we've been trafficking in ETFs for nearly 15 years, and that space sort of looks the same. Like 15 years ago, the exchange traded fund space was, there's probably a dozen names that we could actually trade, and now there's 5,000 products in the world. I'm not saying that's going to happen with crypto necessarily, but there is a lifeline that looks somewhat parallel or similar in crypto, and things will get tighter, and but the assets will also grow, and there will be sort of new and interesting ideas that always pop up when the ecosystem evolves. At least I think that the crypto ecosystem will.
Yeah, so I mean, don't get me wrong, right? Like, dollar euro doesn't have very wide spreads, but it trades 550 billion a day, right? So, there's a lot of assets that can sustain, margin compression, but still be highly remunerative for people who are facilitating them.
For sure, and also one thing that we should bear in mind is we haven't spoken of yet is leverage. When I used to trade fixed income arbitrage, if I found a Treasury futures basis trade that was 25 bips, that was huge because I could lever it 20 or 30 times and make a very good return out of that. Right now, BlockFi is providing some leverage, but nothing like the kind of leverage you get in fixed income arb. And so I agree with Adam that we're going to see a tightness of spreads as more people come in, as more capital comes in, the spreads will get tighter, but then leverage will become more available and people will feel comfortable providing leverage because the instruments will be more liquid. And obviously we know from long-term capital and other problems that leverage and illiquidity don't mix. But if you've got a liquid market, then that can be a levered market. So the arbitrage profits will still be there.
I'm not sure about that. So, I mean, I guess I'd push back a little bit and say, like, why is it that there's no leverage or that it's hard to get leverage in the asset, right? It's hard to get leverage in the asset because the variance is extraordinary, right? And it's not clear to me that, greater institutional participation will necessarily diminish the variance in the asset. Well, right? Like the reason you can lever the basis, 20 to 1 is because the basis is pretty stable, except for, the events of March, right? historically, these digital assets are hard to value, and so they're not stable.
But as the market cap of Bitcoin goes higher because more institutions come into the space, then the impact of somebody selling, say, a 5 million ticket of Bitcoin, which now can have little ripple effect, it just won't even move the market at all. So as the general market cap of the crypto space increases, its volatility is going to fall.
I mean, is that? I mean, that's an argument, I guess. Yeah, I think that's open to question, I guess.
In the TBD bucket, but it seems like there is a general consensus amongst the group that there are a lot of things happening that kind of each contribute to growth of the asset class, which should have positive implications over the long term. And with that, I know we're coming up on our time, so I want to go around the horn again like we did at the beginning and ask folks to share either a prediction that you have for the space over the next relatively short term year or two, or something that's happening in the space that you're the most excited about and you think will be a big deal over that time frame. And then also if folks want to get in touch with you, if there's someone watching this that wants to have a conversation, is there anywhere that you want to mention that they can reach out, either a Twitter handle or an email or something else? And we'll go just like we did with the intros. We'll start with you, Tushar.
Sure. So I'll make a prediction and tell you what I'm most excited about, because
all right,
I think it's the same topic. And the thing that I'm most excited about that I think is most relevant to this audience is what's going on Project Serum, which is a decentralized exchange that lets you trade synthetic assets. It's basically decentralized BitMEX or decentralized FTX. It's being built by the team that built FTX, and it's on the Solana blockchain. So you get a full central limit order book in a decentralized fashion, which was just simply not possible before. It's already live. Like, you can go trade on it today. I think they had their first $10 million trading day recently. And this to me is like what it's all about, because like this thing actually does something, right? It's not a meme coin that you buy and you hope that other people will buy for more money from you later because they want it. Like it facilitates economic activity that creates value and earns cash flows and then returns those cash flows to people who own the token. And I think that that's really cool. Call me old fashioned when I think about things I like to invest in. So I think that that's the most exciting thing going on in crypto today, because I think it's the most important development to crypto market structure since the advent of these offshore futures exchanges that we had maybe like 4 years ago or so, that they started getting really popular. I think moving that to a decentralized infrastructure is going to be absolutely game changing. And I predict that Project Serum starts trading over $1 billion a day 1 year from now.
And if folks want to get in touch with you or engage with Multicoin, where should they look?
So if you want to read more about what we're doing, our website is basically a blog. We like to think in public. We publish all of our thoughts. Sometimes we're wrong, right? We want to think with you guys. We want to think with our community. So go to multicoin.capital to go see that. Or if you want to engage with me specifically, Twitter is the best place to do it. And my handle is @Tushar Jain with an underscore at the end, because I couldn't get the whole handle.
Thanks, Tushar. Ken.
Yeah, I'm going to shy away from making any predictions. I think I would say that like the point that Tushar has made, I think, is sort of like what will determine the success or failure of the crypto space as an asset class over time is the degree to which people are able to utilize it in order to do those kinds of things, where people will be able to sort of create crypto assets that have a utilization other than being a random variable that goes in your portfolio to perform a function, right? And I think that the more people innovate on that, and the more that the general public comes to understand, right, what those things are, and also the other half is, of course, the regulatory environment. But I feel like there is the kind of movement you need to see in the regulatory environment, right? And I think as that spreads, people will continue to use these things in a more innovative way. And once people see real value in actually owning the assets, right, like that's what will turn the key for institutions, right? And by that time, the infrastructure is being built by arbitrageurs and to service arbitrageurs, right? So that by the time the institutions turn the key, right, the infrastructure will be there. But like what will determine whether or not the key gets turned is the innovation process that Tushar is describing.
Awesome. And if folks want to read more about Greenwich Associates or otherwise,
Greenwich.com is our website. My Twitter handle is @foudroyant. It's the French word for being struck by lightning.
All right. Thanks, Ken. Adam, over to you.
Yeah, so I think maybe to build off of what Tushar and Ken had to say as far as the regulatory environment, my prediction would be to have probably getting an ETF over the next few years approved. I think it's been roadblocked for a handful of years for a variety of different reasons. But I think with the ecosystem building out and with obviously the OCC announcement, with obviously competition now with China and others that are popping up here, that the US is going to have to really act. And I think one way to do that would be approving an ETF in the next few years. So I think that's where I sit in the coming from an ETF market making seat, my prediction. And then just as far as getting a hold of me, I'm old fashioned. I have an email, adam@huntinghill.com, or you can reach our investor relations team at ir@huntinghill.com.
Awesome. Thanks, Adam. And Michael, thoughts or predictions, and where can folks find out more about Nickel?
So I think the predictions, this is a pretty easy one, but there's going to be lots more innovation. That's the thing that makes crypto so interesting and exciting, both in the centralized space with all the competition between the derivative exchanges, and in DeFi clearly, of course, as well. So I think we're going to see many more exchanges, but there'll be consolidation between existing exchanges as well. So that to me is a really exciting part of what's going to happen, and we're very interested in that from our arbitrage perspective and multi-strat perspective as well. Anyone who wants to get in touch with us, nickel.digital is our website, and I'm michael.hall@nickeldigital.com. Sorry, nickel.digital.
Got it. Well, thanks so much, everybody. I hope this was helpful for you. I hope everyone watching enjoyed it. If you have thoughts or questions for BlockFi, you can put them in the comments, or reach out to us on Twitter or the normal channels, and we'll take them into account as we keep bringing on awesome folks like the ones we had here today to help educate you. So hope you have a great rest of your day, everybody. Thanks so much.
Thank you, everyone.
Thank you, Zach. Thank you, everybody. Great to meet you all.